this is Tom Wallace, and welcome to another edition of Florida Funders Angel Investing Podcast. I'm really excited about our guest today, Adam Struck, who I'm going to introduce you to here in a second. But real quickly, for those of you who are not familiar with Florida Funders, we're a hybrid between a venture capital fund and a curated angel network or crowd of angel investors. And we're focused on finding, funding, and building the next generation of great technology companies here in Florida. So today we have Adam Struck. Adam is a Floridian, but he is in LA, and he has Struck Capital. And you're going to hear a lot more about that. He's a very successful young man. I've got him by several decades, I know that. He was named to the Forbes 30 under 30 most influential people, which is what an honor that is. Congratulations there, Adam.
Thank you.
And he's got some really interesting investors, including Leonardo Dicaprio, which I just saw, that announcement. Congratulations there. We're going to want to hear more about that. So again, Adam, welcome. And thanks for being on the show.
Yeah, no, appreciate you having me and looking forward to the discussion.
Yeah, so you have a really, I was looking at your background and you're a lawyer. And, that's not something you see a lot in venture capital. I wouldn't say you never see it. But you seem to have a lot of angel investors, venture capitalists go from being entrepreneurs and then into being on the investment side, which is what I did. There's a lot of different paths to get to being a venture capitalist, but you did it at such a young age and you seem to have taken a different path. Tell us about that.
Yeah, so I was born in Johannesburg, South Africa, and definitely came from a very entrepreneurial family. I think I went to Northwestern University and did the Kellogg undergraduate certificate program. So I was always very interested in business and the buy side generally. For me, going to law school was sort of a way just to figure things out because during the time it was the sort of '08 crisis and it really wasn't sexy to go into banking. And then when I got to Georgetown Law, they recruit so heavily, these sort of big law firms, and I sort of just got captivated by Kirkland & Ellis, which is an incredible law firm, a great free market system. They really exposed me to, many, many different deals, but I kind of knew really quickly that I was sort of on the wrong side of the proverbial fence. I make the joke that I wanted to score the goals instead of making sure that the scoreboard was written up correctly.
That's a good analogy.
I literally left Kirkland & Ellis on day 2 after I completed my first year. And I got great reviews for my first year, and they were kind of shocked that I was leaving. One of the partners went to me and just said, listen, I totally respect what you're doing. If not now, then when? And if you don't like it and you want to come back to law, I'll guarantee your job for 6 months. So I felt really good about that. My mother was still crying when I left because I was like her lawyer son, and she wasn't too happy at my older brother.
You said you come from an entrepreneurial background. What did your parents do?
Yeah, so the real entrepreneurial background is my grandfather's. So my grandfather on my father's side, his whole family was decimated before the Holocaust and during the Holocaust, and then he came to South Africa and was literally selling snacks like at a concession stand by a manganese mine. And he ended up saving enough money with a few of his friends, and they bought land that ended up having mineral rights. And he turned that into a company called National Manganese Mines, which was, when my father was, call it in his 30s, a very, very well-known company in South Africa. And on my mother's side, my grandfather, Harry, he was actually very big in steel with his brother Max in Zambia. My mother was born in Kitwe, Zambia, when it was a British Commonwealth.
Oh wow! Both your parents are from South Africa.
Yeah, both from South Africa, and both sort of heavily in sort of natural resources. And it definitely was brought up at a young age to sort of channel your entrepreneurial spirit and want to take risks. I think that gave me a lot of momentum.
So after you left the law firm, did you go right out and start your own firm?
Yeah, so my brother, my brother's 7 years older than me. He's done a lot in the CPG and food and beverage space. He was starting a company called Long Island Brand Beverages, and he wanted me to come and join him. And I said I would, but in the boardroom or in the company, we're equals, even though you're my older brother by 7 years, which is a long time. Our initial thesis for that company, we were really inspired by by Bethany Frankel and what she did with Skinny Girl Margarita. I actually worked on the deal at Kirkland and Ellis when Jim Beam acquired the company. But we thought that there wasn't a lot of really activity or innovation whatsoever in Long Island iced tea. Yet it was an alcoholic beverage that everybody along the Eastern Corridor had a strong affinity towards and drank a lot. So we sort of wanted to have like a RTD ready to drink cocktail that was, sort of Long Island iced tea. We then, as all things happen, right? You make plans and God laughs. We had it's very, very difficult to overcome the low margins and slotting fees associated with any sort of company in the beverage space. And we all of a sudden got an opportunity to be in a bunch of vending machines along the Eastern Corridor. The caveat was the drink had to be non-alcoholic. So we said, wow, that's going to change it up a little bit.
Yeah.
We did a bunch of field testing and we just noticed that there was a massive gap in the iced tea market. At the time, Arizona iced tea was the largest player on the market. They had like 64 grams of high fructose corn syrup. So we thought that if we could come to the table with cane sugar instead of high fructose corn syrup, reverse osmosis filtration to preserve the integrity of the tea leaf, organic, non-GMO, but still call ourselves Long Island iced tea and sort of benefit from the grassroots affinity and association along the Eastern Corridor with that brand. We thought maybe we'd be onto something. And before we knew it, we were in 7,800 mom and pops. We were in Costco, ShopRite, 7-Eleven. We bootstrapped the company to $40 million in top line, and we sold it to a middle market private equity firm.
Wow, great! Congratulations.
Thank you.
So you had a nice exit at an early age.
I did, and then my brother went right in to start another company called Hungry Root, which has raised like a little over $50 million to date, backed by Lightspeed and Crosslink and Lehrer. He wanted me to join him, but I said, listen, bro, as much as I've enjoyed the ride, I'm going to now go and do my own thing. I was a lot more attracted to technology and SaaS and 10x revenue multiples, of course. So he sort of went and continued on the entrepreneurial route. He's had tremendous success. And then I went and started doing a bunch of special purpose vehicle investments to get a track record and then ended up launching Struck Capital. But it's a really cool situation because, for example, in January, assuming the pandemic permits, he's going to come out here and I'm going to, introduce him to a ton of VCs. He knows them all already, but it's a really cool situation that sort of as brothers, we can help each other out in these sort of synergistic ways, me being on the capital side and him still being on the entrepreneurial side.
Yeah, that's awesome. We share two things in common when I hear that story. One is I started my first company with my brother. And he's my older brother too, so he's a lot smarter than me. Just ask him; he'll tell you.
Oh, there it is. Yep.
and then I was 23 when I started my first company. So when you were telling the story that the lawyer said, if not now, if not when now, I always like to see young people take the risk and go out and start entrepreneurial ventures. And what better time? What do you have to lose? You don't have anything. So if it goes bad, what the heck?
I definitely agree. I tell some, I have some friends even to this day, they have these sort of golden handcuffs in big law. And, you just say, it's like, well, when are you going to make the move? Like when you have 3 kids and the mortgage, you got to try at some point. So I'm glad I took the risk when I did. Yeah,
good for you. So you start Struck Capital, and what was your vision from the beginning? And tell us more about the journey at Struck Capital.
Yeah, so I kind of stepped back and I said, wow, I'm really lucky to have this exit, and I've got this, operational expertise now. I've got legal expertise. What would be fulfilling for me? And I had a few buddies that were in tech, working at sort of blue chip funds like NEA or Andreessen. And I kind of realized that listen, if I could sort of initially position myself as a real value add angel, sort of angel investor, I could go to companies that I thought had strong KPIs and they were raising subsequent rounds of financing, led by tier 1 firms. And I could say, listen, carve me out a $250K or $500K or $1 million allocation in the round. I'll put up more sweat equity per dollar invested than any fund on your cap table, and I'll work my butt off. And I wasn't opposed to sort of trying to make, customer introductions, help with talent acquisition, do all these things even before I had the opportunity to invest. Because my goal was to sort of, generate a track record for myself, convince myself that I could actually do venture capital and add value to these portfolio companies. And then, of course, get as many people as possible sort of comfortable with the Struck Capital brand and with me sort of being a fiduciary of their capital. So
now, let me interrupt you. How did you get to LA though? Because you did the Long Island iced tea in New York, right?
Yeah, correct.
How'd the LA thing happen?
Yeah. So at this point in time, I'm still in New York.
Okay.
Did Long Island iced tea and then started doing SPVs. I got really lucky. The second SPV I ever invested in was in Postmates, and that was back in 2014. So
how early were you in Postmates? Was it early on?
Yeah, it was between the A and the B. So they actually completed their acquisition 2 days ago. That's a nice win for the investors.
Congratulations.
Thank you. Yeah, so I did like 18 SPVs, and I got to a point where I realized that there were tech entrepreneurs and individual, various family offices that they were really taking a portfolio approach to my deals. I'd send them 5, and they would do 4 of them. So I realized, hey, I really have some proprietary access here. And then I decided, okay, now I would really love to leverage this track record and launch a fund. And my goal was to raise 25 million. I ended up closing 32 million. And during that fundraise, I was actually brought to LA, and I just felt like, wow, this is such an incredible ecosystem right now. And my wife and I were really tired of freezing winters between Chicago and New York and Georgetown. We decided, hey, let's just do it. Her sister went to UCLA Law and was working at a Melvin and Myers here in LA. I have an aunt here in LA. And we got an Airbnb in the Hollywood Hills and never looked back. I now have my daughter here, and we live here. I'm going to be here for the rest of my life.
Yeah, that's great. For our listeners who don't know what an SPV is, I just want to clarify that. That's a special purpose vehicle, which basically means that, Adam, you're putting together an LLC and going out and finding investors to invest in these individual deals like Postmates. Sorry, I missed out on that one, by the way.
Yeah, well, listen, you see DoorDash. When I invested in Postmates, they were definitely leading DoorDash, materially leading them. And now, DoorDash is IPO and gets some like $30 billion valuation. So, it all depends. You never know how it's going to work out.
Yeah. And we do that with our investments here in Florida Funders. Our fund puts in usually half what we're going to put in, and then we form an SPV, go out to our angel network, and they fill out the round. So SPVs are something we use really every day here, just about. So
definitely, and it's the nice thing with SPVs, you don't get management fees, but you're in the carry for every deal that you do because they're sort of separate. So some advantages for sure.
Yeah. So you're in LA, and when I was reading about Struck Capital, getting ready for this, the mission struck me as very similar to what we're trying to do with Florida Funders and trying to change Florida into being a state. We like to say a state known for technology and innovation instead of one known for the mouse and strawberries and tourism. And it sounds like you're on a very similar mission in transforming LA into being known for technology. Tell us about that.
Yeah, 100%. I think, since I've been in LA, it's just incredible how much has changed. But I think that sort of force multiplier is happening again and again and again. And I think if we look at LA today and then we fast forward 5 years, it's going to be a similar level of change. I just think sort of what I realized very quickly was there really is a strong hotbed of engineering talent here. There's more engineers in Southern California than anywhere else in the United States. So when you have the engineering talent, there should, so it's a very interesting, data point. And when you have sort of the engineering talent, you should be in a position that you can have, sort of homegrown companies that can go all the way. I think Snapchat, though, is sort of the first example where people saw that, wow, you can really build something in LA. You can IPO, you can have that multi-billion-dollar, market cap, and really and establish yourself as a category leader. And when I came out to LA, even though there are a bunch of strong funds here, I still felt that it was a real greenfield. And we've gotten to a point in basically 5 years that we're the 4th largest dedicated seed fund in LA, and I think we've been able to capture a lot of market share in a short period of time because the mindset that we take towards venture capital is a little bit different than some of the legacy VCs here. I say that you sort of have to really look and feel like the seed stage companies that you're backing. So we try and move fast, we try and break things. We don't like any bureaucracy. We have no problem adding a ton of value to portfolio, to prospective portfolio companies before they agree to term sheets or before there's an opportunity to invest. And I think just generally, too, sort of being young, we've been able to outflank some other VCs because these young founders want to work with us. So it's pretty incredible to me that LA is such a huge market, and yet it still feels young. And I'm sure you get a very similar feeling in Florida as well. And that's lovely, right? Because that just means that if you practice the art of venture capital the right way, you can grab a lot of the market.
Well, the other thing in Florida we see, and I'm curious as to if this is the case in LA, is the valuations are a lot different than what we see in San Francisco, Silicon Valley. So we think we're able to invest in companies who are good companies, have good products, at a valuation substantially lower than if they were in the Valley or San Francisco. You're really close to San Francisco and the Valley, obviously. So how do you look at that?
Yeah, I think it's a really good question. I think what happens in Silicon Valley is you just have a lot of these billion-dollar behemoth funds that, from their perspective, if they get into a company at a $10 million post or a $20 million post, it doesn't really make the difference to them if they're truly underwriting that it's a category leader. There's no question about it. Sort of LA deals are at much lower valuations, and it's an advantage for the fund as a whole. I think generally we, our main goal is to invest in LA and ensure that we can help sort of buttress the totality of this ecosystem. But we're also noticing that places like Austin, places like Denver, places like Florida, there's very good opportunities to invest. So we don't shy away from investing there as well. But what we do shy away from are sort of these deals that we know right away. These are just like very high flying Silicon Valley deals, that are going to get done at these ridiculous valuations. We don't actually waste our time. We want to know what they're doing and we want to understand them for market mapping purposes, but we don't waste our time sort of writing them term sheets because you're 100% right. These billion-dollar funds, they'll come in and they'll just take it and they're not really that valuation sensitive, which is pretty interesting.
Yeah. One of the things I wanted to ask you about, because I understand that kind of one of your secret sauces, and I've heard this, is the value you add. And you alluded to it earlier, that you start adding that value even before you invest in these companies. Tell us, what is the main way you're able to help founders grow their business, and how do you look at that, and how do you help these? And we do the same thing here. I mean, it's a big part. We don't just write checks, and I know it's a big part of your success formula. Tell our listeners more about that. I think they'd love to hear that.
Yeah, it's this interesting thing. And I'm not trying to say anything bad about venture capital as a whole, but I just find generally that a lot of VCs, they write checks and then they kind of disappear. Their definition of adding value is calling a founder once a month or once a quarter, asking for KPIs, and they promise to make an intro, and then the minute the phone call ends, they get another email and they forget about it. We really try and productize and systematize the way that we add value, and we've actually infused even core technology innovation into our own fund to make it easier and more scalable in terms of the way that we help our companies. Even though we're an industry agnostic fund, I'm a firm believer that building a company, whether it's a fintech company or a SaaS company, there's very similar patterns, and these founders are all going through similar issues. So if we can sort of be proactive instead of reactive and create tools that we know are going to extend across the portfolio and add value, then that's something that's worth our time, and we go really, really deep on that. So for example, we have a lot of companies that find product market fit, but what separates a good company from a great company is not only finding product market fit, but then getting to a point that you can get those sort of 10Xers at legacy companies that are similar to yours to sort of abandon ship and join your mission. So talent acquisition, in our opinion, is what makes or breaks a lot of our portfolio companies at the earliest of stages. So what we've done is we've actually developed a script in-house that can take job descriptions, pattern match them to LinkedIn profiles, use a bit of machine learning to then find additional LinkedIn profiles that match those LinkedIn profiles, and then automate outreach on behalf of our founders. And if we do it the right way, we just kill when it comes to top of the funnel. All of a sudden they're like, hey, I'm trying to find this senior backend engineer, and we've got eight individuals that match the statistics you're looking for that have already opted in to introductions, and then we make the connection. So that's just like a great example of how can we be proactive as it relates to talent acquisition versus what maybe a lot of other VCs do, which is like, oh, you're looking for this person, like hire a recruiter, or you need to go scrape LinkedIn, or, oh, I'll see if there's someone in my network, and then nothing happens. We have a head of platform at Struck Capital, and the reason for that is we really want to productize the way that we add value.
And it's so much of this is about talent, right? And building the right team.
100%.
Yeah, that's awesome. I want to go back to Postmates for a second, because I was thinking about that further while you were talking. How did you find that deal, and how did that come about? And are you still in it to this day?
Yeah. So Postmates was acquired by Uber in an all-stock transaction. We are all waiting right now for them to officially give us the Uber stock.
Okay.
So we'll see what we're going to do after that. But yeah, it's really just about being very well networked. So, given that I sort of sold a company in the F&B space, I have a few people in my network that know Bastian, who's the CEO and co-founder of Postmates, and I was just really able to hound him relentlessly and get an allocation. And it's really that simple. I find that if you can really humble yourself and put in the effort, even though maybe you're going to get nothing out of it, and you can actually show that there's some material way to add value and move the ball forward, a lot of founders are going to be really open to it, and I think it really also usually has to happen at the earlier stages, because once they hit Series C or Series D status and they're a category leader, it's a lot more difficult. But,
Sure.
Postmates at the time when I invested, they were still struggling a little bit. I mean, they had strong KPIs, but it wasn't this beautiful symphony that it is today.
And if you don't mind me asking, how many times return will that be for you guys?
Yeah, so it's a really nice one. It's over 15x, but from a valuation
Did you say
perspective,
15 or 50?
I said over 15. From a valuation perspective, it's not from a multiple perspective, it's not as large as you would think from a valuation perspective. And the reason for that is, and I blame Bill Gurley for this, honestly, is he was really anti the gig economy. And when Postmates was trying to sort of raise its Series, I think D or E, it was very difficult for them to do. And Founders Fund really bailed them out and got 100% warrant coverage as a byproduct of that investment.
Okay.
So for everybody on the cap table except Founders Fund, your multiples are not going to correlate to the valuation, to the entry point valuation and exit point valuation.
Okay.
But still a great way.
Yeah, 15x. Take every one of those we can get, right?
Exactly. And what we were underwriting really was sort of being an operating system for the gig economy. And we do believe that played out. So that's always nice.
Good. Well, great. Congratulations again. Tell us, have there been, on the investment side, have there been any investments that you passed on that you look back on and they really took off?
Yeah. Listen, there's a lot of deals that we pass on and then we do a postmortem, and it can be frustrating. But at the same point in time, I've heard a lot of stories about VCs that had looked at sort of that initial instantiation of Uber and they passed. And I actually don't think they passed for the wrong reasons. I think the one that specifically comes to mind is Limebike, just because I know Toby, we had a chance to invest, and we said no, and 2 days later, Andreessen then invested, and then 6 months later, they were worth $1 billion. We'll see what happens, to a lot of those companies in the space, given COVID, et cetera. But there's such a healthy secondary market for Lime that we would have made a lot of money and would have been able to take a lot of capital off the table. But yeah, listen, we get it wrong a lot. The key is really sort of having conviction and why you make the decisions that you make. And another thing that we've kind of realized as well is, as our gravitas increases in the ecosystem, we're seeing deals earlier, but sometimes it's actually a negative, especially at the seed stage, because you see a deal, you pass, and then you find out 3 months later that a fund that saw it later than you is doing the deal, and the company has hit some incredible KPI and they've got product market fit, and now they're very investable. So we really try and just track the companies that we pass on, because we want to make sure that doesn't occur.
Yeah. Well, if it makes you feel any better on Uber, when I first heard the idea behind Uber, I thought it was the stupidest thing I ever heard of. I'm like, wait, some stranger's going to come to my house and pick me up in their car, and I'm going to get in a stranger's car, and they're going to take me to the airport, or they're going to take me to a restaurant. I just didn't get it. But
Yeah, and I heard that when Travis and everybody went out and pitched Uber, they were all working on different companies, and their deck wasn't great. It's very interesting, right? Because today, if a founder came to me and they're like, I'm pitching this idea, but I'm working on another company, I'd be like, well, well, then we can't do business, So it's just very interesting how things pan out.
Yeah, you never know. Now, when you say seed means different things to different people. What stage are you typically investing? Are you investing pre-revenue?
So there's a really sophisticated, institutionally backed pre-seed environment here in LA, and they are the ones that are really investing sort of pre-revenue and with micro traction. I would say our seed stage bets are similar to where maybe Series A was 5 to 7 years ago. These companies have, call it, I would say at least 30K in MRR. We will do, sort of pre-seed bets as well, but those are then sort of, smaller checks with very special founders that we usually have pre-existing relationships with. The majority of the time, we want to see material unit economics, and we want to see strong signs of product market fit. And
what is your typical check size when you're investing?
Yeah. So we're doing $1 million to $1.5 million. And our typical, I would say to everyone, like 7 pre, 10 post. So if you're doing a $3 million round, we can come in and take $1.5 million and take 15%, or we don't mind being flexible and taking 10%, and, even 8%, it depends, in co-leading, there's a lot of optionality there. But yeah, typically $1 million to $1.5 million.
And what percentage of your original investments do you end up doing follow-on investments in?
Yeah, so the fund is structured in such a way that we save 50% for follow-on. The way Fund 2 is performing right now is I may even save 60% for follow-on because we're doing very well. So technically, I tell founders that, listen, if you hit your KPIs, and a tier 1, blue chip Silicon Valley fund is leading that subsequent round of financing, we're going to support you and we're going to participate. And we're actually structurally set up to do so up to the close of the Series B. After that, it gets too concentrated, and we also love to offer those co-investment opportunities to our LPs. But yeah, I mean, we are set up to follow on, and we want to do that. Okay,
I'm going to switch gears a little bit. You brought up LPs, so tell us Leonardo DiCaprio. How did that come about?
Yeah,
him as an investor.
The story's not as cool as everyone I would like it to be. What I would say with Leo is, he's got a really, really sophisticated investment team behind him. They got to know us over like an 18-month period. So in that sense, it was a slow burn. But I think, without putting words directly in Leo's mouth, I think, he really shares a passion for the LA community, and LA is his home. And, LA is my home, and we share the exact same passion for the tech community and LA as a whole. It's a huge feather in our cap. Leo obviously has this incredible platform that's related to green tech and green energy, but he's never actually publicly associated himself with just like a tech fund that's industry agnostic, let alone an LA fund. And I find generally that a lot of VC funds look the same. We all talk about disruption and innovation, and yet our models and the way our capital is very commoditized. So to get the opportunity to partner with Leo and his platform, for our founders to know that if they take capital from Struck, ipso facto, they're taking capital from him. And if they do things the right way, maybe they can leverage his platform in the future. I think it's a huge differentiator for us, and we feel really privileged to be associated with him. But yeah, just generally, he has a very sophisticated team, and we got through a very lengthy diligence process.
Well, congratulations. That's
Thank
great.
You.
When you start talking about technology and innovation, some of that's regional, right? It's different in different parts of the country. We see that here in Florida. What do you see? You mentioned LA has more engineers than any other place in the country. I didn't even know that. That's very interesting statistic. What do you see as the innovation or the opportunities in your area that you tend to focus on or look at?
Yeah, I confuse people a lot because, my background as an entrepreneur is in CPG, F&B, and yet when I invest as a venture capitalist, the majority of the time we're doing horizontal vertical SaaS. We love like API infrastructure, plumbing plays. We're doing a lot of fintech. I truly see LA as a, sort of industry agnostic tech hub. I think there's enough engineering talent here, especially now with what's happening with COVID, where there's this mass exodus from San Francisco. A lot of them are coming to LA and Austin. There's enough empirical data to support that you can literally build any company that you want here in Los Angeles. So, we're finding incredible SaaS companies. We're seeing incredible marketplace companies. We're seeing incredible healthcare, mental health companies. Obviously, there's obviously social media and green companies like Honest Company. There's a lot here. So we really don't limit ourselves. I think there's LA used to be known as like, the only thing you can build here is sort of media companies and it has to be Hollywood related. And I really think that couldn't be further from the truth. I think you can build anything here.
Yeah. No, I love that. And we believe the same thing about Florida. We see really all kinds of companies, cybersecurity, fintech, digital health, and we see Florida very much the way you were saying is technology agnostic. And so, we're excited about it. We did our first LA deal. It's a gaming company, and we have a pretty decent gaming pocket in Orlando. Electronic Arts has a big office there with 1,000 employees, and the University of Central Florida has a master's in gaming, which is one of the top-rated gaming programs in my understanding the country, but not the world. And we have a bunch of cybersecurity here in Tampa, but to your point, we really look at it. It's pretty wide open, and we see that as a plus. Anything else you want to share with our listeners, and any other anecdotes or advice you would give investors, and when they're looking at investments before we sign off?
I would say generally, I think there's a lot of fear out there, with sort of the pandemic and the longest bull market in history, and a lot of quantitative easing and all of these things. What I would say to people that are looking at venture capital and deciding on if they want to have sort of some semblance of this asset class as a part of their diversified portfolio, what I tell people is we're investing in innovation. And I think there's an incredible opportunity right now to sort of back first principle thinkers at opportunistic terms who see the world differently and sort of see that there's an incredible time right now to sort of take core technology innovation and use it to adapt to sort of new ways of living. So in that sense, we're more excited than ever. And, I encourage everybody that's listening to this, when the pandemic allows, make your way over to LA, check out the scene, check out what we're doing over here. And, always happy to have, a strong entrepreneur stop by the office, and we can talk shop.
Great. Well, next time I'm in LA, I'm going to take you up and come
Please
see
do.
you guys.
Lovely. Yes.
I miss traveling out there, and but the vaccine's supposedly coming out any day, so hopefully we're in the back end of this whole pandemic, and we'll be back to the new normal, whatever that looks like. But we agree with you here at Florida Funders, and you look at the technology and innovation that's coming on in the next 5 to 10 years, artificial intelligence, blockchain, augmented virtual reality, autonomous vehicles, quantum computing, the wealth opportunity, the wealth creation opportunity, both for investors and entrepreneurs, we think is absolutely unprecedented. And the next Googles and the next Apples are, they're in somebody's garage in LA or somebody's garage in Tampa or Miami, and it's just an exciting time, both as an investor and again as an entrepreneur. So, Adam, thank you so much. This has been awesome. You have a great story, and you're so young. I wish you all the best. I'm sure you're going to continue to be very successful, and hopefully we'll do some more investing together. We're in Flex Engage, an Orlando company, together, and hopefully we'll do some more deals together.
Yeah, would love it. Really appreciate the opportunity, and looking forward to meeting in person one of these days.
Great. Likewise. To our listeners, thanks for joining us. Really appreciate it. If you want to learn more about Florida Funders, just go out to our website, floridafunders.com. Whether you're an investor or a founder, if you're a founder, we have a very easy application process to get into our deal flow process. It'll take you about 10 minutes to apply. And, and thanks again for joining us. Have a great day.